Everyone, it's Arash Adnani from privateplacements.com. We're doing it big today. We're doubling the value, doubling the fund. We have two of the greatest natural resource speculators and investors with us today. If there was a private placements Hall of Fame, they would both be first round inductees. I couldn't think of two other people to have here on the channel to talk private placements and investing. Mr. Doug Casey, Mr. Rick Rule. Gentlemen, thank you for being here today.
Pleasure to be with you, Arash.
Likewise.
So we see a lot of you guys do interviews, you guys do conferences, but one thing I want to do before we really get into the nitty gritty here is take a step back. And if each of you could just give me a quick history of how you actually got started in the business. Rick, let's start with you maybe.
Fine. I emigrated to Canada as a young man to attend the University of British Columbia, both because that was the only school in North America that had a major in natural resource finance, and also because they were unlikely to send me to Vietnam, both of which I thought about as being good outcomes. I cut my teeth in Vancouver in the restaurant and nightclub business because I had to put myself through school. But as soon as I was able to dispose of those hospitality interests and go to work directly in natural resource investing, which is in the latter part of the decade of the 1970s, I did so. I've been continually employed in natural resources and financial services ever since. I've been an active investor in public natural resource markets now for 49 years.
Okay, thank you for that. Doug, how about you?
Well, I think the first thing that I ever wanted to be when I was a little kid was a paleontologist, which is to say, I like dinosaurs, which a lot of kids did back then. And later on, since paleontology is a division of geology, I got interested in that. And then I started getting interested in money, always was, but a little bit more. So I combined those two interests. You combine geology and money, and you wind up with mining, which is really kind of a stupid business, I've subsequently learned, but nonetheless, that's what happened. And I guess my first adventure with mining stocks was with South African mining stocks way back in the day, in the 70s, the mid 70s, and then got involved in the Canadian markets. And I guess Rick and I have been friends for, how long has it been, Rick? At least 40 years.
I believe we started doing business together actively at the end of 1987. So yeah, every bit of 40 years.
Pretty close, yep.
Yeah.
So safe to say that, and I know mining companies love to do this on their management slides in the investor deck, but safe to say we have 80 years of combined experience.
Yeah, I mean, you know, Doug has expressed interest in paleontology. Probably that's why he hangs out with me. I'm a fossil.
Okay, so that's a lot of years of experience. Now, with that also comes a lot of mistakes, I'm sure, especially earlier on. Can you share with us some of the lessons learned that you still carry with you to this day that really help guide you in your decision making and your approach in investing?
For me personally, there were at least three. The first was having experienced the bull market of the 1970s. I didn't understand the cyclical nature of natural resources. I didn't understand that markets work. I attributed the money I made in the first bull market to my own brains, not paying attention to the fact that gold went from $35 to $850 and oil went from $3 to $30, and they were likely to round trip. So I went from, at the end of the 1970s, being a hubris-ridden and very wealthy young man to having a net worth a bit south of zero, and an understanding of just how smart I was, which is to say, not very. I would suggest that my second mistake was not constraining the number of people that I do business with. Pareto's law is very true, and I've made probably 90% of the money that I've made with 10 or 12 entrepreneurs over the last 50 years. Probably had I only hung out with people who made me appreciable amounts of money by my mid-30s, I would have worked half as hard, had 10% the aggravation, and made twice as much money. My third observation is that small mines can only ever make you small money. Big mines can make you big money, and both have the same risks associated with them. So chasing anything other than very large projects is stupid, unless you're a stock trader, unless you're trying to monetize greater fools. What I've learned is that there's no particular point in taking big risks for small money. Since exploration is all about big risks, it has to be for big money.
Yeah, and I will absolutely second and underline everything that Rick said. You're absolutely right, Rick. I made all the same mistakes. So let me repeat the three things that you've said. Yeah, you're totally and absolutely right. It was the same in my case. But, you know, I needed a methodology to go about this so I'd stop making mistakes. And that's why I put together the what I call the 9 Ps to stop myself from doing stupid things. We all do. We all react. So I try to force myself to look at my 9 Ps before I put any money on the table. That's how I stop myself from making mistakes now. I'm too old to make mistakes at this point, or I should be too old.
So, and we have, by the way, for those who don't know the 9 Ps, we have done an interview with Doug where he goes extensively into the 9 Ps. So we're going to link that in the comment section, because today's interview, we got lots more to cover. So jump on in the comments link to see that one. As speculators, and you guys, you know, when I think speculating, when I think private placements, you guys are two of the names that come to mind right away. I always find it interesting when speaking to people that are more economists, and you know, they're all about the macro data, and then talking to speculators. It seems like you're just looking at different metrics and KPIs. As speculators, how much time do you spend looking at the more macro level metrics with what's going on with the economy, with inflation, if we're in a recession? What do you look for? What metrics do you look for when you're informing yourself about any moves you're about to make?
Well, I've got to say that looking at the macros has gotten me into a lot of trouble in the past, but I've had a lot of fun doing it because, you know, one of my interests is history and collapse of civilizations and so forth, decline and fall of the Roman Empire. And problem is when you take a too big view from 30,000 feet, you miss a lot of the details. And the details are where the devil and the profits lie in these crazy mining stocks. So I'm trying to, and I know Rick is very good at this. It's reading the footnotes in annual reports. And to do that, you actually have to read the annual reports, which is not really much fun per se. So put those two things together. A big macro view to see where the world is going, and reading the footnotes and annual reports to see where your crappy little mining company is likely to go, or get a better idea anyway.
Rick, can you tell us about some of these footnotes and what things specifically you look for when you're looking at the annual reports?
I was laughing because Doug and I both have an affinity for fiction. His fiction is more commonly called literature, and my fiction is more commonly called accounting. I in fact enjoy reading annual reports, if for no other reason than to watch how people legally gild a lily. And so I certainly do pay attention to footnotes, and you don't have to go too deeply. If you look at an exploration company and you look back through 5 years of balance sheets and income statements, and you find a company that spent more than 25% of the money that they raised on selling general and administrative expense, which is to say less than 75% went in the ground, you either have a company that's inefficient or a lifestyle machine, as an example. That one's fairly simple. If you look through management resumes And you see people who are on the board of directors or who are officers, and they don't have, they have not experienced success at a task directly related to the task at hand. What you'll see is a company that was assembled in a way that's suboptimal with regards to achieving the outcome. Let's say, as an example, Arash, that somebody tells you that they've been a success in mining, but it turns out that the success was in operating a producing gold mine in 2 billion-year-old Archean terrain in French-speaking Quebec. But the task at hand is exploring rather than producing for copper gold in 15-million-year-old tertiary volcanics in Spanish-speaking Peru. The tasks aren't very, very, very related. I would also say, in response to the question that you asked Doug, that for different reasons, Doug because of history and philosophy, and me because of my background in credit, that from a macro point of view, over 40 years, Doug and I have been consistently too bearish. I joke that Doug and I have correctly called 17 of the last 3 declines. And what you find is that there are all kinds of cycles. Some are macro cycles, some are commodity cycles, and it ends up that if you make a discovery in the most dismal of all economic climates, it doesn't matter. Making discoveries pays you well. It's also true that you must approach cycles from a counter-cyclical point of view, which is to say that one of the things that macro is helpful for is buying assets when they're out of favor. You, as an example, try to buy uranium stocks when the uranium price is well below the cost of production, and people hate uranium. When uranium comes back into favor, and believe me, it will, that's not the time to be buying the stuff. It's the time to be selling the stuff. So what macro is useful for is a contrary indicator, because money is made not on the price of a stock, but rather on the delta between the price and the value. Prices can be depressed relative to value when the sector is out of favor. So that's the way I try to use my, macro. But Doug is exactly right. You make money on the micro. You can inform yourself by the macro.
So right now we're at an interesting time. If we're looking at macro data and we're looking at what's going on in the natural resource business, it would seem like there's a lot of opportunity for buying. There's a lot of things happening. There's uncertainty. You would think this is like a speculator's kind of dream to be coming into a space like this. As speculators, do you thrive in a situation like this, or are you waiting for things to maybe settle down a little bit, for the dust to settle down, to see if there's an indication one way or another from the Feds if this so-called technical recession is going to end soon or not? How are you both looking at the current marketplace and the space that we're in right now? Rick, maybe let's start with you, and then we'll get to Doug.
I'm pretty optimistic as a private placement investor. The junior mining market has been pretty overheated for the last 3 years, which meant that private placement terms, from my point of view, didn't price in the risk. There were too many small hedge funds. There were too many generalists. There was too much dumb money in the space. Mm-hmm. And if you compete with dumb money, you're dumber yet. We've come into a circumstance now where the junior mining stocks are again solidly out of favor, which meant in particular that issuers that played chicken with capital markets, issuers that didn't raise money when they could in hopes of higher share prices, are now going to have to raise money when they have to.
Yeah, and we talked about that recently, yeah.
Which means that the terms are going to favor me. I'm negotiating a price placement right now, with a company that I believe is selling at half of intrinsic value. I'm actually paying a small premium to market for this private placement. But the consequence of that is that I'm getting a 5-year warrant. 5-year warrants on companies that are selling at substantial discounts to net asset value are pretty attractive.
Yeah.
And I'm noticing more and more circumstances where the economic circumstance is more balanced again between the issuer and the check writer. The check writers, of course, don't like that. Pardon me, the issuers don't like that very much. But for the few remaining check writers who care, I count myself prominently among them, we're coming into a period, I think, where we get even for 3 years of poor pricing.
And so,
Well,
sorry, go ahead.
Rick, I certainly hope that you're going to invite friends and family into this private placement you're arranging on this company with a 5-year warrant, because that's exactly the kind of deal I like.
Remember, when I have a full wine cellar, all of my friends have wine.
Well, I'm looking forward to that. But I think, Rick and I agree on almost everything, Arash. We really do. And right now, as we speak in mid-August, a lot of these big mining companies, I'm talking about Newmont and Barrick and things like that, are down really substantially from their highs of some months ago, really a lot. And the same is true of the little companies. So it's the ideal time to go shopping. And that goes for private placements, especially. The big boys in New York are anti-gold, just because they've been educated to believe that it's a pet rock and that the Federal Reserve really controls things, and we're not getting a lot of competition right now,
right,
from any source. The public has been pretty beaten up in this bear market that started when stocks in general started melting down, and mining stocks with them, and oil stocks with them. So that this is an excellent time to go shopping if you can find decent companies that want to raise money.
Okay, so on the topic of going shopping, and before I ask this, Rick, I want to come back to the deal you're working on afterwards, because that sounds really interesting. But when talking about shopping and shopping for private placements, how are you guys approaching different private placements? Are you guys contacting the company? So do you have your spreadsheet of companies that you like, you think they're undervalued, you'd like to get involved, and you approach them, you contact them? Or are you waiting for companies to approach you? You'll look at what they got, you'll like it, you might not like it. How's it happening? Are you approaching, or are you being approached?
For me personally, I find most of the issuers exist at the conjunction between lazy and stupid. And they're not going to approach me. When they need money, they go to the capital markets dealers. Mm-hmm. They love to be lied to. The capital markets guys say, yeah, we'll raise you $10 million. Let's do this and let's do that. And then the capital markets guy, if it's easy, raises the money. Otherwise, they use the market out clause. Too bad, so sad. So no, I don't do that. My suspicion is that maybe 5% of the listed companies in the space worldwide are worth investing in. And I have a shopping list now, between 150 and 160 companies. And I'm approaching them. But I myself, in my declining years, as you note, Arash, I'm sort of retired. Working 8 or 10 hours a day in a suit and tie. But anyway, what I've done is I've built up a database of people who are interested in what I do that has about 80,000 people in it. And I'm now telling those people that I will give them notification of the private placements I do if they're accredited. And what I intend to do then is write to somewhere between 150 and 200 public companies worldwide and say, I'm very interested in providing private capital to you on good terms. And I will, if you'd like, inform, very much like you do, Arash, all of my subscribers who are interested in private placements as to what I'm doing with my own money. I don't charge commissions, I don't charge fees. So from the regulator's point of view, I'm not soliciting anything. Mm-hmm. What I'm doing is merely recounting for those people who care what I'm doing with my own money, and if the issuers think it's appropriate, including contact details. So I'm sort of automating what I do using a couple of young interns, that is to say research assistants, using my Rolodex, and then using my contact base to help companies that would like to raise capital, deserving companies that would like to raise capital outside of mainstream channels.
So how does someone get on one of these PP invitation lists?
All anybody would have to do is to go to ruleinvestmentmedia.com. By the way, if you do that, you can enter all of your natural resource portfolio there, and on a no obligation basis, all rank it 1 to 10, 1 being best, 10 being worst. But in the question and comments section at ruleinvestmentmedia.com, if you mention placements, I will put you on the private placement list. There are certain guys like Doug Casey who don't ask to ask. They just get on the list. Doug, whether you want to or not, but
Well,
I'm looking forward to that. That's what I'm going to do in my declining years.
I definitely want to, Rick, no question about that. How do I go about it? Rick's methodology is absolutely sound. I guess I do the same thing that Rick does, but I'm not quite in the same way. I've got a good Rolodex, and I like to stay in touch with people that over the years I've learned don't lie, cheat, or steal,
Right.
and are technically competent. So once in a while I hear from them, and so once in a while I reach out to others. So that's one thing. There are a very few good newsletters out there written by guys that are competent and honest and so forth. And they're out beating the bushes for private placements, and I get into those that I like. So pretty much the same thing, although I haven't made a business out of it the way Rick has, which is
I've made a business with no apparent payoff, Doug. It's an odd business for me.
So,
well, yeah, we're just trying to keep busy, actually.
Yeah, keep amused.
so Rick, for your list, so someone signs up, they get on the email list. If you're looking at a deal and you're going to move forward with the deal, you'll send an email alert inviting those who are accredited to join you for a certain allocation that you'll have to a financing. Is that the way it works?
I don't necessarily get an allocation. After the company has issued a press release, I will send out an email to all of those people who have signed up to be on my placement list.
Yeah.
And if the company allows me to, I will put a company contact on the email saying there may or may not be an allocation. In the placement that I'm negotiating right now, the minimum placement will be $2 million US, and I've guaranteed to take all of it. I've guaranteed to take all of it so that I leave room for my friends and family. My inclination is that I'll take $1 million out of $2 million, and I'll leave $1 million for people on my list.
What's the minimum
frankly,
investment?
If I had to put up $2 million into a company that I think is selling for half what it's worth, a company that I think can grow tenfold over 5 years, and I get a full warrant for 5 years, I do it. That's fine. But I'm trying to put in place a circumstance where, as a consequence of volunteering to take all of a placement or put together a syndicate that takes all of a placement, where as a consequence of that, I can avail my readers of a participation, I'll do that. There will be circumstances where the only placee on my list that gets placed is me, particularly where I'm participating in a placement that's led by Sprott, my former employer, or some brokerage house that has their own list of institutional people who need to be included. But if I originate one, I'm going to do my very best to see that my own community, both my friends and my readers, have an allocation.
So Rick, I love content that actually has actionable insight or opportunities. In this case, let's call it the 5-year warrant deal. This 5-year warrant deal you're working on, once you announce it to your PP list, what is the minimum investment for someone on your list for that $1 million allocation?
That'll be between the company and the placee.
Okay.
I'm out of the brokerage business. The last thing I want to do is negotiate the minutiae of individual participation.
Got it. So you'll be hands off.
Spoiled. Yeah, company's been spoiled the last few years, Arash. You know, I talked to some guys who say, yeah, I'd like to do a placement with you, but I don't want to take any tickets less than $500,000. I said, well, you know, good luck.
Yeah.
That isn't what I want to do. And I suspect that isn't what they should do. It's a bit of a pain in the butt processing a whole bunch of $20,000 tickets, but it gives you a much better shareholder base. The stock trades, and a lot of those $20,000 tickets are sort of library cards for people who would really like to own $200,000 worth of stock. So when I get somebody who says, you know, I don't want to mess with people less than $500,000 or less than $1 million, I thank them for the conversation and move on.
So can you tell us which metal the 5-year warrant is in?
No comment.
No comment. When do you expect to find out or be able to share some information?
I would expect this calendar week that we will have the placement lawyered, and I won't have to worry. I won't have to worry about somebody who is more generous than I taking the placement out from under me.
Okay, noted. We'll follow up with you on the 5-year warrant. Doug.
I look forward to it.
So Doug, you mentioned you follow a couple of newsletters that cover private placements. We're feeling very generous today, so we want to do maybe a plug or two for these newsletters. Can you share with us one? Do you care to share which one you like? Which one is your favorite that offers the best quality deals?
Well, let me think. Marin Katusa is doing pretty much the same type of thing that Rick is doing at this point, structuring deals and making them available to his readers. So you ought to reach out to Marin, who's located in Vancouver.
And that's KatusaResearch.com for the viewers, KatusaResearch.com.
There's a chap named Hodges that I get his stuff, and some of the deals that he rounds up are quite good.
I pay attention to Brent Cook and Joe Mazumdar, although they aren't primarily. It isn't primarily a private placement letter. It's a letter that's written by two very high quality geologists, and I like their securities analysis. And when it's appropriate, I approach the companies that I read about in their letter.
Very
good recommendation.
So that's 4 really good leads. We'll post the website address for each one on the screen so the users can follow up with those. One thing that I noticed right now is so you guys are both in a very unique situation where you have the resources and the Rolodex where you can quickly assess a deal, approach management team, you'll have the relationship, round up some other investors and get involved with the PP very efficiently and very kind of seamlessly. For a lot of people that don't have the years of experience, they don't have the Rolodex and they don't have the know-how of how to do that. So they're kind of coming in like most people. Do you think there's pros and cons to investing on your own, so looking at private placements by yourself and just investing in them individually, or looking at things like the Sprott RED LP fund? It's a PP, natural resource focused fund that does basically what you guys are talking about, but on a more professional level. What would you say are the pros and cons to doing it by yourself versus basically giving it to the professionals to do it for you? Rick, you come from this world and you also have the experience. What's your opinion?
Sure. I mean, People need to understand I'm the largest single shareholder of Sprott. So if people participate in the Sprott LP, I'm an indirect beneficiary. So let's get conflicts of interest out of the way.
Disclaimer.
The people who run that fund too are people who I mentored. I'm fond of them and I want to see them succeed. I have always suggested all of my life that the best manager for your money is you. But that assumes that you manage your money. There are people who don't want to have to work as hard as you have to work to invest your own money. I've suggested for years that speculators limit the number of stocks in their portfolio to the number of hours per month they're prepared to spend researching those stocks. With private placements, the workload increases substantially. Remember that you get restricted equity. So if something goes wrong, you are stuck. So I really think the function or the question about whether an investor does the work himself or herself or has it done for them depends on whether or not they enjoy it and whether or not they have a life. If you're not going to do the work, if you enjoy your kids or your grandkids reading, golf, fishing, gardening, your job, if you aren't prepared to be a semi-professional investor and do the work yourself, then by all means do the Red LP. If you've reached the stage in life where you're starting to understand things and you want to increase your deal flow, do it yourself and do the Red LP. They don't need to be mutually exclusive.
Doug, how about you? I mean, managing your own money versus getting professionals to do it.
Well, I agree with everything that Rick has said. Again, everybody is looking, or perhaps should be looking, for the next Warren Buffett. I'm not exactly sure where he is. Everybody's looking for him. But until I find something that I'm sure is Warren Buffett, the only way I invest in small mining companies, almost always the only way, is with private placements. And the reason for that is that, first of all, I can get the stock usually, depending on the market, at a discount from what it's trading at. 5%, 10%, sometimes 15%. That's a big plus. You don't pay an overt commission. You're always paying somebody, but there's no broker involved that you're paying, that you pay the commission to anyway. That's a plus. You always, or should always, get a warrant. These warrants can be for 6 months, for a half warrant for 6 months, or they can be a full warrant for 5 years. And at best, sometimes those warrants are just detachable and trade as separate securities. So there's a wide range of things. But when you're doing a private placement, you get a KISS. Now, why do you get a KISS? Because, among other things, you usually have to hold the stock for 4 months. You can't just buy it or discount and blow it out. So you're taking a risk for 4 months. Well, depending on the discount, that can actually sometimes be a good thing. So I almost always, when I'm investing in exploration, which I try to stay away from incidentally, and development stocks, which I do a little bit more of, mostly actually, I get into the market through private placements, not by buying in the open market, typically.
And so, Doug, do you have right now, other than investing in private placements yourself, would you ever put money with a private placement focused fund for more reach, less work on your end, or do you prefer to do it yourself?
No, I'm all for doing both, actually.
Spread it out.
Yeah, absolutely. Because I've got other interests in the world other than playing with crappy little mining stocks, frankly. I mean, life is short and it is amusing, but there are other things that I want to do. So I'm tending more towards paying somebody to manage my money. And I don't know, is that typically mean 2 and 20 standard, Rick? Is that what would go down with the Sprott fund you're talking about, 2 and 20?
I think we've seen a compression of fees, which is a good thing. And a correctly structured fund at the very top end of the management fee would be 2%. They're more commonly 1.5% now. And the performance fee should be after a hurdle, which is to say that the investors should enjoy a 6 or 8% return before, or at a very least, a return equivalent to the US 10-year Treasury, the so-called riskless rate. So when I give, I mean, you know, I used to, as you know, Doug, manage on a 2 for 20 basis. And I'm willing to pay 2 and 20 if I like the manager, but the market would seem to be 1.5 and 20 with the 20 net of a hurdle, which I think is fair. I don't want to pay somebody to try, but I want to pay somebody well to succeed.
Yeah, no, I'm with you because I have 2 managed funds right now. One is in cryptocurrencies. I mean, I know something about them, but it's a giant field and my knowledge is shallow. So I've got a deal with Marco Witzer managing cryptos because the potential exists with them to get 1,000 to 1 shot still, although most of them are crap, which is true of most small mining companies as well. And I have another managed fund with Chris McIntosh, who basically lives on his Bloomberg machine, looking for companies that are burned out and where you can buy the stock for less than the money in the bank and things like that. That's the kind of things he does in obscure stock exchanges in obscure places in the world. So those are 2 things that I don't want to spend the time and trouble with, but I can see the upside. So yeah, I'm all for managed money with the right perspective.
So let's switch focus to our favorite metals. There's bargains all over the place. The bargain bin is looking full and healthy. You can't buy every metal, or you could, but let's say you were to prioritize your favorites. Which metals do you like? And again, we can't make any promissory statements here, but we can just make cases as, you know, for example, uranium with the Biden Clean Energy Act and gold for obvious reasons. So Rick, let's start with you. What are some of your favorite metals going into the final stretches of the year and 2023?
My favorite theme is an investor, and I want to segregate between investments and speculation. My favorite theme as an investor is still oil and gas. Biden saying you need to drill more, but I'm going to make sure that your business is a stranded asset by 2030 sort of means that the type of investment that he would like to see isn't going to be sufficient to make sustaining capital investments, which means that the supply of oil and gas is going to continue to be constrained for most of my life, unless we come into a real recession. The speculator in me is very different. With the speculator, I'm looking at a more, or pardon me, a less certain upside, but a much more dramatic upside. And that has to be uranium. I've, as you know, Arash, been pounding the drum from time to time on uranium for a very long time. I was in it in 2015, 2016. I was out of it in 2021. We have a circumstance now where the stuff is priced at $47 a pound. The global incentive price for current production is about $60 a pound. The global incentive price for new production is probably $75 a pound, which means I'm relatively certain, absent a global depression, that the price of uranium over 5 years goes from $47 to 75 or 80 bucks. That in and of itself is not a bad internal rate of return. In other words, you could buy the Sprott Physical Uranium Trust and just participate in the upside of uranium, which I think is more or less certain, absent global economic catastrophe. Or you could construct a beta account, which is to say the biggest and the best uranium companies worldwide which you think will substantially outcompete the other equities markets available to you, or you could construct an alpha account, which is to say you come farther down the quality trail to what we believe are the 12 uranium juniors that are viable out of the 75 listed uranium juniors worldwide that we can track. And I think all of those work. So as an investor, I want to be in the oil and gas space, you know, companies with 12, 15 years of proved developed reserve life that are trading at 3 times cash flow, generating 50% operating margins. I mean, it's just, you know, there's a reason why Buffett bought 22% of Occidental, why he filled his boots on Phillips, why he filled his boots on Chevron. I mean, these stocks are stupidly cheap. So from the investment side, I'm in the oil and gas business and happy as a clam. As a speculator, the uranium stocks have fallen like a boulder off a bridge at the same time that the pace of Japanese restarts has increased, which is to say, the upside in uranium has become sooner rather than later, while the stocks are off by 50%. It's a wonderful circumstance for a speculator.
And as a speculator in let's say the uranium stocks, and you know, you guys did that uranium masterclass recently, and there was the symposium, the in-person event that you had. What are you finding the sentiment to be with the rest of investors? You know, you're dialed in, you're convinced, but yeah, where do you see the retail market being on this?
Please note that my investors are a self-selecting list. If you hang out with me, you're going to have a sense of humor for uranium, or you're going to stop listening. Most investors, even those who consider themselves contrarian, aren't. They want to be contrarian when it's popular. Yeah. They're momentum investors. So I remember being vilified on social media a year ago, saying that the uranium stocks were overpriced. Now the uranium stocks, the juniors, have fallen by 50 or 60%, and all of the people who vilified me are saying that uranium stocks are overpriced, having fallen 50%, just at the time I'm getting back into it. I'm extremely comfortable with circumstances like that. Buffett says you make money by buying straw hats in winter, by buying assets when they're out of favor. So the fact that uranium is out of favor, the fact that you can buy a wonderful company and likely see it fall 20% in price in the next month is a good circumstance for me. I'm very comfortable with that.
Are you looking at anything outside of energy?
Well, I think the gold stocks relative to the price of gold are historically cheap. That isn't to say that they're absolutely cheap, because they never are, but they're relatively the best values they've ever been. I believe, but I can't tell you when, or even really that, we're going to have a gold bull market. I mean, a real gold bull market. I think we're in a hiatus in a gold bull market now. And historically, when gold establishes momentum, silver goes further and faster. And so I'm actively looking at trying to participate either as a private placement speculator or directly back in the junior gold and silver space, having established very, very, very full positions personally in the senior producers, both in terms of silver and gold. Now I'm looking to redeploy back in a sort of a risk-on basis, now that all of my competition is in a risk-off basis. I just, I try and do what the so-called smart money won't.
So yes to energy, yes to precious metals. What about some of the funkier ones like lithium, even copper?
I'm a sucker for a tier 1 deposit, and I don't care what it is. Would I be in a lithium deposit if I saw it being tier 1? Tier 1 being, you know, $7 or $8 billion in recoverable in situ reserves and resources, in the best quartile worldwide in terms of all-in sustaining cost, and in the best quartile worldwide in terms of return on capital employed. I don't care about the commodity. I don't care about the narrative. I don't care about the name. I made a lot of money in sand and gravel and water, you know. So the headline narrative doesn't matter much to me. The project economics and the people involved make a lot of difference to me.
Which goes back to one of your 3 lessons learned. If you're going to aim and put money into this stuff, go big.
Yep.
Because either way, you know, it's the risk is there, so you might as well aim higher. Doug, how about on your end? Are you do you have any favorite metals that you're tracking right now? Anything that just gets you excited, like uranium gets Rick excited?
Well, the number one metal, of course, is gold, and gold stocks really are cheap. And the reason I say that is that the average all-in sustaining costs of gold, very different from cash costs, which many years ago were the only things that people looked at, are $1,000 or so an ounce, about that. But so that's industry-wide for producers. But the market price for gold is about 1,800. And gold is, in my view, fairly priced at this point. So these gold companies are basically coining money right now. So I think they're a good place to be, but nobody wants to own them. The big fund managers think gold is a pet rock, and the younger generation don't want to get involved in it because it's playing in the dirt with big yellow machines. I mean, that's a far cry from developing an app and making $1 billion overnight. So now's a very good time to buy gold stocks. And as Rick pointed out, silver tends to be gold on steroids, because the people that get in back of silver, they treat it like a religious icon. And cyclically, there are a bunch of silver letters out there that give you all the reasons, some of which are valid, why silver could go to $100 or $200 an ounce. I don't buy it, but now's a very good time to get into silver too, and copper as well. I mean, it's copper. There aren't going to be a lot of copper mines put into production over the next decade for all kinds of reasons, not least of which is who wants to spend $1 billion on the if-come-see that'll go into production 10 years later when you're fighting the government for taxes and royalties and NGOs that are, it's a horrible business, generally speaking. So no, I'm interested in all of these things right now. I've got to say that I'm anxious at some point, a year from now, 2 years, 3 years, I don't know, 4 or 5 perhaps, to sell all of my metal stocks and buy some kind of a business that can produce things for the public reliably and predictably and would grow. Type of things that Warren Buffett would buy, because in the past, he's never owned resource stocks just because they're way too risky and way too subject to outside elements. But I guess he's starting to buy some oil stocks, and maybe he'll start buying some mining stocks, maybe sometime in the future, maybe.
Well, we're at a special time. I think you know, about a year ago, people were complaining everything's too expensive, and now here we have this opportunity where you can pick up producers, juniors, whatever you're into, at steep discounts. So this is the time to buckle up and get serious about your natural resource investing and exposure. I want to thank both you guys for making this happen. This was very, very, very informative, and the PP investing talk we love. We don't get enough of it. So we're happy to bring you guys together, share some of the stories and the philosophies and how to invest in PPs. Rick, Doug, appreciate your time. Thank you very much for all the insight.
Thank you.
Thanks, Arash.